Elon Musk can become billions of dollars richer without receiving a normal paycheck. Meanwhile, your paycheck arrives, taxes take a bite, rent takes another bite, and DoorDash finishes whatever is still breathing. So, how does someone become unbelievably wealthy while sometimes showing surprisingly little traditional income? Is Elon hiding money inside a rocket? No. The real explanation is both completely legal and somehow more annoying. Today, we are breaking down how Elon Musk's wealth is structured, how wealthy investors reduce taxes, and which strategies normal people can actually use without owning a rocket company. First, we do not have Elon Musk's private tax return sitting on our desk. So anyone claiming to know every deduction he takes is either guessing or has somehow become his accountant. What we do know is how Tesla has publicly structured his compensation and how the tax rules generally treat salaries, stock, loans, and investments. Most workers trade their time for a paycheck. The paycheck becomes taxable income before you even get emotionally attached to it. Elon Musk's situation is very different. Tesla's public filings say Musk stopped earning a base salary in 2019, and his major compensation was structured through performance-based stock options rather than normal cash pay. That does not mean stock options are magically tax-free. Depending on the type of option and when it is exercised or sold, taxable income can still be created. The IRS explains that stock options can create ordinary income, capital gains, or both, depending on the option and holding requirements. But here is the important part. Simply owning an asset that increases in value generally does not create a capital gains tax bill until there is a taxable sale. Question: if your stock rises from $1,000 to $10,000, do you immediately owe capital gains tax on the $9,000 increase? Usually no. If you have not sold, the gain is generally unrealized. Once you sell, the difference between your proceeds and adjusted basis generally determines the gain or loss that must be reported. This is the first billionaire advantage. Their wealth can grow inside assets without appearing as a normal paycheck every 2 weeks. You probably cannot ask your employer to replace Friday's paycheck with 5% of the company, but you can begin moving part of your income into assets that may grow over time. The goal is not to avoid earning income. The goal is to use some of today's income to buy assets that can support tomorrow's version of you. Now we enter the part of billionaire finance that sounds like someone discovered a cheat code. Imagine you own $1 billion of stock but need $10 million to buy something modest, like a yacht with a smaller yacht inside it. You could sell stock, but selling appreciated stock can create a taxable capital gain. Another option may be borrowing money while using the stock as collateral. Question: is borrowed money normally treated like taxable salary? Generally no, because a genuine loan creates an obligation to repay the money. The IRS describes loan proceeds, such as reverse mortgage advances, as loan proceeds rather than taxable income, although specialized loan rules and interests still matter. This does not make borrowing free. You owe interest, the lender can require more collateral, and if the stock falls, your financial plan can turn into a live-action disaster movie. So should you borrow against your $500 of investments to avoid selling $20 of stock? Absolutely not. That is not tax strategy. That is financial cosplay. What regular investors can copy is much simpler. Avoid unnecessary trading and do not constantly sell long-term investments to fund short-term wants. Taxes also care about how long you hold an investment. Sell too quickly and gains may receive short-term treatment. Hold longer than 1 year and many investments may qualify for long-term capital gains treatment. The IRS generally defines investments held for 1 year or less as short-term and those held for more than 1 year as long-term. Question: should taxes be the only reason you keep a terrible investment? No, saving money on taxes does not help if the investment falls through the floor. Taxes should influence a good decision, not rescue a bad one. Billionaires use complex structures, but regular people have something far less dramatic and often more useful: retirement accounts. Yes, I know. That sounded less exciting than a yacht inside another yacht. But accounts such as a workplace retirement plan or an IRA can provide tax advantages that ordinary workers can actually access. Depending on the account, the tax benefit may happen when you contribute, while investments grow, or when qualified withdrawals occur. The exact contribution limits and eligibility rules change, so always check the current IRS rules or speak with a qualified professional. Question: what is the easiest version of this strategy? Start by understanding your employer's retirement match, because ignoring free matching money is like declining part of your compensation. Here is another strategy commonly used by wealthy investors: donating appreciated assets instead of selling them first and donating cash. Suppose you bought stock for $1,000 and it is now worth $10,000. If you sell it, the gain may create a tax obligation. But donating qualifying appreciated property directly to an eligible charity may create a charitable deduction based on applicable rules while avoiding a sale by the donor. The IRS says donated property may generally be deducted at fair market value, although adjustments, limits, qualified organization rules, appraisals, and itemization requirements may apply. Question: should you donate $10,000 of stock purely to save $2,000 in taxes? No, you still gave away the asset. The strategy makes sense when you already want to donate. Tax savings should support generosity, not become an excuse to make terrible math feel sophisticated. The biggest lesson is not become a billionaire and borrow against 300 million Tesla shares. The lesson is that wealthy people think about the form their wealth takes. $1 of salary, $1 of stock growth, and $1 borrowed are not automatically treated the same way. That difference can shape when taxes are triggered and how much flexibility someone has. Most regular people focus only on earning more. But building wealth also requires asking where the money goes after you earn it. So here is the realistic version of the Elon Musk tax playbook. Number 1, buy productive assets instead of spending every raise. Number 2, use available retirement and tax-advantaged accounts. Number 3, avoid unnecessary selling and constant panic trading. Number 4, understand holding periods before you sell. Number 5, track legitimate deductions and business expenses if you actually operate a business. And number 6, talk to a qualified tax professional before attempting anything involving loans, stock options, large donations, or complicated ownership structures. Elon Musk does not have a magical tax button hidden inside a Cybertruck. His advantage comes from owning valuable assets, receiving unconventional compensation, controlling when certain transactions happen, and having access to professional planning. You may not have billions in Tesla stock, but you can still copy the underlying mindset, earn income, buy assets, use the accounts available to you, minimize unnecessary taxable transactions, and plan before you act. Now let me ask you, if your income increased by $500 a month tomorrow, how much would become an investment and how much would mysteriously disappear into upgraded subscriptions? Be honest, Netflix already knows the answer. Comment your answer below, subscribe to Wealth Files, and remember, the goal is not to imitate a billionaire's lifestyle. The goal is to understand the system well enough that more of your money stays yours.